Mark, why don't you take it away?
Thanks, Ken. And thanks, John Kimmel, for being our Sergeant in Arms down there in the Wichita area. Hopefully you had an okay holiday. But welcome, everybody, to the December edition of the Roundtable. It is a time of joy and leaning on friends and family, and we hope that all of you have had a wonderful December and will continue to have a wonderful Epiphany season. If you're joining us for the first time, an extra big welcome hug to you. We'll cover the program here in a minute, but I just thought I'd throw up a couple of images. There's a few things there. I'm joined by my friend Ken Kabula, one of the leaders in the Michigan, mid-Michigan area. We work with a lot of investment clubs. Second guy there is Cy Lynch from the Atlanta area. Third is Hugh McManus, and I'm Mark Robertson. We've all been involved with investment club related education and analysis for many years. Ken, I'm getting a little typing noise through, so you might want to, I think that's you. Guilty, because I can hear your heavy typing. And again, we just want to kind of celebrate that investment club thing. Every once in a while we get a little bit sappy or whatever you want to call it, but we'll do that again here for a few minutes. That is, the picture on the left is a snowman or an ice sculpture of a knight. And just one of our favorite images this time of year. Very well done. And you will notice that we've dubbed this session the Otters of Wall Street, with the picture of the two otters there floating. And as I've shared with some of the subscribers at Manifest Investing, I did go to the Wolf of Wall Street here recently, and that's kind of what it's a takeoff on. The Wolf of Wall Street movie put together by Martin Scorsese, starring Leonardo DiCaprio. It is the story of Stratton Oakmont. It's basically that story. You've heard us here talk about Boiler Room, the movie from several years ago. It's the same company, it's the same story, only in this case it's told from the perspective of the leaders of that organization, and frankly they were, ripping a lot of people off and ultimately got caught. And again, it's if you're a real hobbyist investor or whatever, and you don't mind the F word, and I have to warn you, if you go to it, the F word is prevalent. In fact, the movie sets a new world record for the number of times over a 3-hour period. Think 3 times a minute for 3 hours, and you'll get some feel for what I mean. So if that makes your skin crawl, be forewarned. But if you look through that, it really is quite an interesting expose. And as Don Danko, the former editor of Better Investing magazine, used to talk about the movie Boiler Room as the exact opposite of what we do. Boiler Room is this, penny stock, very speculative, dripping in fraud type operation where everybody's basically a lone wolf or whatever, and that's where the otters come in. We're not that. We basically do operate in groups and teams, even those of us that are out there as individual investors, leaning on local model clubs or events like this where you can compare notes and hear ideas and share ideas. And that's what the otters are all about. Not wolves, but otters. And somebody posted this on Twitter today, and I borrowed it. Sea otters hold hands when they sleep so that they don't drift away from each other. And I think that's got some excellent connotations for investment club and successful long-term investing, especially when you do it with friends. And that's what we attempt to do. So let's go ahead and get on with the program. We'll get the official stuff out of the way. We will talk about real companies in real time. We are demonstrating the analysis techniques and the philosophy of the modern investment club movement. This is all about education, and no investment recommendation whatsoever is intended. Here's our agenda. We'll spend a little bit of time talking about the scoreboard. Some of the companies that have done extremely well for us actually do have fairly low return forecast, so we might talk about a couple of hot seat type challenges. Going to take a quick look at 2013 as a year in review, and then we'll go through our stock selections. Once again, Mr. McManus is all shopped out apparently because he's having a hard time with his shopping, and will elect to pass, although we'll kick around a few names and perhaps get some commentary on some healthcare stocks and that type of thing. Cy's going to cover EMC, and by the way, I almost picked EMC, so that was almost a double down here tonight with the two of us. And our track record here, whenever two of us have doubled down on a stock during session, is pretty good, so I probably should have gone that way. Ken Kavula is going to cover Fastenal, talk about a long-time community favorite that has generated impressive returns for a large number of our community citizens over the years. And then I'm going to go with Solar Winds, ticker symbol SWI, a company that has actually performed quite well and been quite a roller coaster here over the last couple of years. So those will be our selections as we get started. If you are joining us for the first time, we do take this relatively seriously. We're trying to identify, ideas that we do think will work out. We're not just throwing stuff at the wall to see what sticks. We all take a pretty careful look around, as evidenced by Hugh's reluctance to go with it. And he just doesn't see anything that seems to be attractively priced enough for him to take the shot right now. Our intent is to build a tracking portfolio that has a long-term relative return outperforming the Wilshire 5000 by 5 percentage points. That's 500 basis points. And it's an ambitious goal, but one that we think is achievable based on our experience as we witness literally decades of experience in this realm. Our community has a number of individuals and clubs that have had success. We all know that there is no such thing as a guarantee, but we see an awful lot of clubs operating in that 5 to 10% relative return zone, and even the ones that are in that 2 to 3% zone, we deem them a success because they're outperforming the market. And in fact, even some of those that come in slightly under the market, they're certainly outperforming the stuffing of a mattress. We do like to see 3 out of 5, roughly 60% of the selections that we make outperform the market as we track them and hold them in that model portfolio. So let's go ahead and get started with a bit of a scoreboard. And again, get the party hats out, the noisemakers, maybe even shoot off a little bit of fireworks. We are at an all-time high when it comes to the relative return of this portfolio since July 2010. We've actually picked 175 stocks or made 175 decisions since July 2010, and we have outperformed the market by 360 basis points, or a positive 3.6% percentage points over that time frame, and we are operating at an all-time high. And the trend here is obviously the type of thing that gets our attention. We really like that trend. And I think everybody here that's been involved in investing knows that you can go through periods that are kind of difficult, as we did a couple years in, but this trend is definitely the type of thing we like to see and doing quite well. We're actually pretty close to that 60% objective also. Roughly 57% of our selections have outperformed after selection. Any comments on that, guys? Yeah, go ahead, Ty.
Yeah, I was looking at this chart a few minutes before we started, and I just wanted to point out that that low point around the 2-year, 8-month point or so earlier this year, from where you see the real uptrend start, was about the time I was licensed into the ministry. So I don't know if there's any connection there.
Could be. That never hurts. And anything. I thought you were going to make a point of some stock that I had picked, but thank you for being gentle. And I don't know how you guys feel, but size is the one that most often reminds us that every once in a while our selections take time, and it takes time for our selections to be successful based on the methods that we follow. Any thoughts on that?
No question. If you got instant feedback of how smart you are from the market, everyone would be investing all the time. But the fact is that it sorts out the patient from the impatient, and there's a lot of impatient people out there, which is good because they sell you when things are low and they want to buy from you when things are high. I love them.
Yeah, I mean,
I'm trying to fix them, but they won't listen.
Yeah, he was notorious for loving a stock that's being loathed. I mean, a good loathing period is a good accumulation period, right, Hugh?
Certainly is. I favor companies when they're doing that. they're suffering and starving, and everyone's pounding it. I'm good Samaritan.
Oh boy,
good stuff.
We're going to be.
You started it, son.
I know. I let the cat out of the bag, or the horses out of the barn, or something.
But it does take patience, and I just love that saying that patience is genius in disguise.
All right, let's go ahead and talk about 2013 because, wow, it is that year. I did not expect this year. I mean, I expected, relatively lukewarm performance this year, and If you take a look at the S&P 500, it's up over 30%. So is the Wilshire 5000. So is the value line, arithmetic average. It's kind of hard to find something that's not up at least 30%. This is one of Ken's favorite charts over the years. It really points out, what can happen in any given year. You're looking at the total return for all of these years just with the blocks thrown at it. And we almost got to that 40 to 50% pretty rare opportunity. So Ken, we have an update on your chart. And it's in a good place.
I wonder where the block goes next year.
Well, any one year, I mean, that's part of our message. There's no way to know. There's really no way to know.
The interesting thing is, after such a horrendous recession, worst in 80 years, you can see that 2009 through 2013 were pretty good years.
Oh, yeah. And anywhere on this right-hand side.
Flowing back from where you were in 2007.
Yeah. And, of course, many of us lived through those green bars in the late 1990s where that was pretty nice at the time. Mm-hmm. And, again, numerically, if you took a look at our stocks over the selections, and we're going to look at them here in a second and give Ken a chance to thump his chest a little bit, we're actually up at a relative return for just this last calendar year. Again, that's not 10%. Absolute return, that's 10% relative. So if the portfolio is up 30, or if the benchmarks are up 30, we're up 40 over the last calendar 12 months. So that is an awesome number, and that of course accounts for that trend that Si said we were being divinely guided by. Good stuff. All right, here's a look at the stocks that have accomplished that. And again, we don't want to spend a whole lot of time on it other than to point out that this is the tracking portfolio. It's available 365, 24/7 at Manifest Investing or as a public link if you just write to any one of us and ask for it. This is the portfolio, and anytime a selection is made by any of the four of us or any of the guest damsels, Ann's here tonight, I saw Nick and Herbert here, and also the audience. So anytime any entity makes a selection, we invest $1,000 into that stock. So kind of decoding the chart again, just to take some of the mystery out of it. Cognizant Technology, which by the way was a pretty strong candidate here tonight, Cognizant Technology has actually been selected by some of us 8 times. So $8,000 invested in Cognizant is now worth almost $12,000, it's $11,700. So you can look up any stock on this table. These are the 20 largest positions, the most commonly selected positions, and you can kind of see how the positions have done. For example, eGov, down here at the bottom, has been selected twice and is now up to $35.80. So $2,000 has become $35.80. So any stocks that we select tonight, whether it's one of the four of us or the audience vote, goes into this table. So pretty good from top to bottom. Walgreen has been selected a number of times and done quite well. I believe every single one of us has selected Walgreens at least once, so that's kind of fun. All right, and again, this chart's available at Manifest or on demand from any of us. So with that, let's take a closer look at this one, and this is just one of those, wow, mighty Casey at the bat moments. What I put together is the all-time leaders going back since inception in relative return from top to bottom. And again, relative return is actual results minus a mirroring or matching investment in the market. So this is where Ken gets to take a bow. He's been kind of hot lately, and we'd all like him to, maybe this is the result of being in 16 different investment clubs, or he's definitely on a streak. And he's been on a pretty good one too, but also we've all been coming up. Si's got a couple near the top there, and I was going to cut this list off at 16, but my name wasn't on it yet, so I had to go all the way down to 20 or 19 to get a Telequint on here, so I could get one on here. But every one of these numbers, yeah, go ahead, Ken.
Buck, I know how fond you are of animals. We need to put a squirrel on this list, preferably a blind squirrel. So.
A blind otter? No,
they do discover nuts. Even blind squirrels find nuts. So I wouldn't read too much into this hot streak. It's just as likely, in my investing experience, to to show 8 or 10 losers in a row for my next 8 choices. So
well,
don't read too much into past performance here.
We all go into those type of streaks. I was in one, a couple years ago. I've actually, if you go a little bit deeper on this, I've got a lot of selections that are right there at the bottom of this list. But I think you can see the audience selections have also been rather spectacular from the audience votes here over the last couple of years. And it's kind of hard to even put context in these numbers. These numbers are so large, top to bottom. It doesn't mean every single one works out, but this is how you get to 5% relative return for the overall portfolio over time. And some really good results there. And you can see Portfolio Recovers on there a couple of times. Ann Manning's on there. Kim Butcher's on there with McGraw-Hill. It's really neat to see, if we are swimming in a circle like otters, holding hands and protecting each other, it's working. All right, let's switch gears and talk a little bit about the challenge or the hot seat stocks. This is the sort of the portfolio just focusing in on 3 major characteristics, most predominantly the return forecast. And the companies with the weakest return forecast right now are Roche, Staples, and 3D Systems. We've kind of agreed that we leave 3D Systems alone as a very non-core stock. And from the preceding slide, I think you can see why. I mean, this is a company that is just absolutely going ballistic. And we might want to talk about some form of protection for that at some point in the future, but it's an example of the type of company that really challenges. I'd like to hear some commentary from you guys on this. My experience has been that the NAIC or Better Investing Method, Value Line, Morningstar, especially those 3 are usually pretty challenged by a very rapid growth, highly successful company, fairly young in its life cycle. Standard & Poor's might be a little bit better at the bumpier stocks, but again, you almost have to put a question mark by the return forecast generated and wonder about it a little bit. Any thoughts on that?
Well, I just would like to reiterate what I said when we first went into 3D Systems, Mark, and that the investment was never made looking for immediate return. The investment was made looking to put some money into companies that, in my opinion at least, were transformational, that they were going to change the way the world looked. They were going to change the way major parts of the world looked. And I think that kind of investing has to be a part of what you're doing, especially if you're trying to maintain a mature portfolio and trying to always be looking forward for where we're going. I love this whole idea of a transformational company, of disruptive technology. And I think 3D Systems certainly is on the cutting edge. Whether that company will be one of the 4 or 5 to emerge victorious, 5 years from now, 8 years from now, 10 years from now, I think the market's still out on that. And that's why I think when I do actual investing in a disruptive technology, I do very small nibbles and bites and pieces of 2 or 3 or 4 companies that are in that space, and then try to have the patience to ignore it for a long period of time.
That's good. It's a good way to do it. This is Hugh. I think the other big challenge with companies like this is that the financial reporting cycle is much longer than the technology cycle. And so you get to a position where the numbers that you look at don't really reflect what the company is doing. And I mean, put it into some context. If you look at patent law, for example, the patents run for 20 years. 20 years ago, the patent for Lipitor was about a year old. The patent for many technology companies, the patents that they were filing, were things to improve dot matrix printers and traditional modems. Technology has progressed a long way since then, and certainly 3D Systems is a company, I think, that benefits and that survives by rapidly adapting to changes in technology. And the way that people analyze companies is naturally by using the numbers, the financials that the companies report. And for me, at least, they're not always a very good proxy for what's actually happening in the company, given a historical record. But the company, an Apple, could have gone through 2 or 3 technology cycles, major product releases. I mean, 60% of Apple's revenues, for example, were generated by products that have been released in the last 2 or 3 years. We're a 5-year horizon company. That puts us, our 5-year horizon approach to analysis, that puts us at a little bit of disadvantage there. I'm not suggesting abandoning everything and adopting a new system, but Standard & Poor's, Morningstar, Value Line, the NEIC/Better Investing approach, all of us, we analyze things in a very traditional way, and really it's a safe way. But it's very difficult to do that when technology is moving so quickly.
I'd like to see us devote some time at a roundtable, maybe in the next 3 or 4 months, Mark, to some of Nicholson's writings about non-core holdings and develop that idea a little bit further about what he counseled in a mature portfolio with smaller amounts of that portfolio, you know, maybe as much as 15, 20, 25% of it. I'd like to see us maybe pull some quotes and do a little bit of looking for I guess justification and for edification as well, to let people understand that better investing is not just this stodgy, plain old buy and hold forever kind of investing. It's not now, never has been that type of investing, according to the writings of one of its founders.
Oh yeah, yeah. And the one thing that comes to mind that you mentioned, Mr. Nicholson, is he was very specific about a company that is emerging, emerging into the land of profitability with an elevated growth rate. And he basically said, be very slow, so long as they continue on a growth trajectory, be slower to sell that stock, because everything is so hyper magnified by a growth rate that high. And the way I believe he put it was that growth rate being that astronomical, it really does correct and also mess up things in a very big way very quickly. And as a case in point, I believe Morningstar and S&P jumped their fair value forecast by like 50% here over the last couple of months. I mean, that's just an enormous move, and it's just very illustrative of that concept. I might get yeah, go ahead.
I'm going to echo a little bit what Ken said as well, because I've had very pleasant and very unpleasant experiences with such companies. They've never been a large part of the portfolio starting off, but the successful ones seem to metastasize and grow, and all of a sudden you have something which you thought was a fraction of a percent of a portfolio, and it becomes 3, 4, even 5%. That happens. Of course, a lot of the other companies, and that's why I think this is a rule where diversification really pays off big time. A lot of the other companies will disappear altogether. Because one of the challenges that people face is they're usually technologists, because I've worked in these companies. They're usually people with high technology skills. They believe in their approach, but they don't have experience in managing the growth of a company. And if you're successful, you're faced with a whole slew of other challenges that you didn't anticipate. Companies often fail not because the technology is bad, because they don't know how to manage it.
Absolutely.
So there's just added risk here, and that's why if diversification, wherever the watchword, it really has to be the watchword with high growth companies.
Right. And the one thing that I would point out, I was just kind of mulling over in my mind as we were talking about it. If I have an investment that would be analogous to a 3D systems, and I can't really think of one, probably from a speculative standpoint. One of my first investments, Delights of America, may fall there, but that wasn't a very successful one, so I can't really draw many lessons from there. But I have invested in a fair number of companies slightly larger and slightly more on the maturing, not quite on quite as much of the explosive growth part of the curve as 3D, but I would suspect what I've observed of companies like 3D, and certainly my experience with companies slightly more mature but still in the rapid growth stage is, again, talking about patience, and I even liked a little bit Ken's thing about buy them and ignore them for a while. I mean, you're talking about a company that's growing at 30 and 40% a year, and assuming that the stock price keeps anywhere close to pace with that, you could, let's say we go a year of growth at 30% or so, and as we saw, I think probably the stock price has appreciated close to 100% since it was picked earlier this year. Next month, it may hiccup, or the traders turn against it, and it will drop 50%, but you've only given up a few months of your return.
That's a great point.
So you'll gasp at the 50%, but still on even just looking at a year, much less you stretch it out for a couple of years holding and looking like Hugh was talking about a 5-year perspective, that 50% is a hiccup. So you have to be wary in those companies, and really, and also similarly, what I experience much more in my faster growing companies is they would explode and then undergo a year or a year and a half of nothing. As far as stock price, the company's still growing, still doing well, but the stock price wouldn't necessarily pull back, but it'd do nothing. And so again, you would say, well, my gosh, what should I be selling? But just be patient. Eventually, it'll, the growth will catch back up to the stock price.
I'm thinking, Si, of my holdings in some chip makers back in the late 80s, early 90s, where they were just having tremendous leaps and gains in price and in sales both, where you just couldn't react on a constant basis to sharp drops or sharp increases, where it really was best to, and I don't mean completely forget about it, but it was best to just not watch them on a weekly or even a monthly basis. It was it didn't give you the right idea. I want to emphasize again, Mark, that holdings like this should not occupy 90% of your time in managing your portfolio.
No.
And that the huge part of your portfolio, 80, 85, 90% of your portfolio should be in what I characterize as up, straight, and parallel, and it should be the kind of companies where I'm going to settle for a 10, 12, 13% return on a regular basis. And if I beat the market by 2, 3, 4 points on those kind of stocks, I'll feel myself having done a pretty good job.
Yeah, and I was just going to suggest maybe we get Si to talk about his experience as a fairly early investor in Home Depot at that future session. So I'll make some notes and we'll see what we can do. Kind of moving along, this is the average of the entire portfolio, and that's just what's shown here. The return forecast for the entire portfolio checks in at about 10%. Tonight, the average return is right around 5%. So we are right. We're kind of in that mode of we don't really have to do anything. We don't have to really get in and dig in and think about Roche or Staples. And what we have kind of agreed is Staples, Hugh's thesis is that the analysts are wrong, that the end game profitability is probably a little bit higher than what they're calling for. We've been watching Staples using non-core methods. And again, this is a slide from last month, but again, most of the selections that Hugh made came back in this circle here. So he's done pretty well on them, and we aren't going to go into this now, but it's clearly got a bunch of momentum, and we'll watch that for when the momentum stops, and perhaps act on it at that point. But let's go ahead and leave that subject and just kind of move on. All right, well, Hugh is up first tonight, and once again, he shared with us.
Mark, before we move to the 4 nights, could you just take about 3 minutes? We're having a number of folks still confused as to why par is so low for high-growing companies. They're having a difficult time separating those two numbers. Can you just speak for a couple minutes to that idea once again, and why you can have a high-growing company with a very low par?
Yeah, and probably the easiest way to characterize it is Well, first of all, they're two different things. The growth of the company is basically, in most cases, the top line or the sales growth forecast for the company, and the PAR stands for projected annual return. That's the return forecast. Growth and return are two different things. They're obviously in the calculation. They're joined at the hip, but they are two dramatically different things. Here's a case in point. I'll go ahead and jump out of the PowerPoint just for a second here, and let's go ahead and jump to this is an example that we used when people asked us about this out in Seattle. Hugh and I were on a panel out in Seattle, and 3M, a company growing at, I don't know, 7 to 8% perhaps. It has since gone up significantly from when this chart was prepared, but in fact right now, if you look at Manifest, this return is now closer to 0. So again, a company, let's call it a 7% growth company, can have a 0 or even a negative return. It just simply means the stock price has gotten ahead of itself. The stock price is high, basically bringing down the return forecast. So they're two different things, and you have to really keep them separate in your mind. I don't know if that helps or not, but that's really the way you want to think about that. You can have a huge company with a dramatically low growth rate, and vice versa. You can have a 2% growth company that has a 20% return forecast if the price is in position to generate that. Does that help or not? Anybody any further follow-up questions, or anybody else have any thoughts on that?
No, that helps a lot. I guess that the other end of that question is that's what gives us opportunity in a market when stocks become undervalued and overvalued. That's what gives us the opportunity to make money in the stock market then.
Well, actually, we put together a really quick sort, not using Hughes exact methods, but in this case, looking for relatively high opportunity stocks or potentially opportunity stocks, and they are hard to find. But in this case, what I want to draw the attention to, especially the people that have that question, is just kind of eyeball this is the sales growth forecast column on the far right, and you can see most of those numbers are kind of high single digits, and then take a look at the return forecasts here, and in most cases high teens. So again, that's a situation where the return forecast can be significantly different than the growth rate. And I guess with that, Hugh, we'd like to hear your thoughts on how tough it is to shop out there.
Yeah, I track a number of companies. I mean, ideally I like to add companies that I already own. I like to buy more of the shares, so I kind of track those guys first. And I'm not going to touch Ameren, which I talked about before, but AeroVironment, but its price that I noted it closed at today was $19.95, but it's still more expensive than what I bought it at. And it's not near enough to its 52-week low. It's 27% of the way down. Target actually has come on the radar screen, but for obvious reasons. That it doesn't seem to like to take very good care of its customers' personal information. So we'll see how badly that gets whacked over the next few weeks. Chances are it won't, but we'll see. But it's still priced, 29% of the way to its low, and it's twice as much the average price that I bought it at over the years. But the one I'm really keen on for next year is Eli Lilly. And I've mentioned this before. I love Eli Lilly, so what I'm about to say is in no way trashing the company or anything like that, but I do like the company. I think it has a very strong future. The problem is that its lead drugs involved is about to go off patent, and it's going to lose about 20 to 25% of its top line. Now, obviously, people have noticed that. The pipeline looks relatively good. They had 5 drugs in phase 3 as of October, and when they updated the pipeline at the end of October, they're now at 8. Most of them are biologics. That is, they're large molecules, not the small organic molecules that you typically get in a tablet, like an aspirin or some of these drugs that are advertised on TV. Large molecules are generally injectables. They can be very effective as well, but they also have a slightly higher failure rate in phase 3 where you're really showing efficacy over a broad population than do small molecules. So, not that I'm bad-mouthing Pfizer, but or Lilly, but it is going to have one or maybe two failures in phase 3 early next year, or the first half of next year. And at that point, the proverbial chickens come home to roost, as it were. Analysts, I'm sure, will start hammering on the company. And if it happens, they'll bid that price down. It closed at just over $51 per share today. I'm hoping it can get into the high 20s. Now, I have it in the portfolio. As I said, I love the company. I'm sure a lot of people out there love it too. But I want to buy more of it, but I don't like to pay a lot of money. So Lilly is the one that I'm looking at very closely. And the other one recently was Cisco, which has gotten beaten up a little bit, and I'm not really sure if I understand fully the reason. But yeah, if it gets, if the price drops below $20 a share, I'll certainly get very interested.
Yes, Cisco is one that's been selected a number of times by us, all of us.
Me too.
And
yeah, we bought it in the teens.
There were a couple big research reports out this week that were basically under the tagline, sell Cisco, buy Nokia. Yeah. And there could be some deep value there at Nokia too, but that's a little speculative, in my opinion.
Yeah, exactly.
You know, and again, Ken just mentioned, or one of you guys mentioned, you know, things that Nicholson said. One of the things he cautioned about, and I think where we're at today actually fits it pretty well. When a market's been in bull mode for quite a while, one of the things you'll find yourself tempted to do is to sell a company like Cisco, which is, most people would consider it a pretty good blue chip, kind of a core stock, and dump it for a turnaround play. You know, that could work out. That could work out, but I've done that bad a couple of times, bad enough to know that it can be a pretty tough road.
Well, just for me, you know, I buy companies as close to the 52-week low, a multi-year low. If it's a smaller company, I buy it as close to that point as possible. I've also tried to enforce a discipline that if ever I get to the point of selling, I try to sell near its 52-week high or multi-year high. I find it's very easy to let go of a small company that has done spectacularly well, particularly if the interest in the general market is perked up and a lot of people want to buy it. If I held it for 3 or 4 or 5 years, then capital gains isn't a huge issue. So I've done that once or twice. And yeah, if I were to sell anything, it wouldn't be Cisco.
Yeah, you can see here in the value line, 21 is pretty close to this 52-week low.
Yeah,
so it's got to be somewhere near the bottom of or top of Hugh's list, any way you want to look at it. One thing we thought we might ask you about, Hugh, for any comment whatsoever on Edwards Life Sciences. Any knowledge, or it's a company that's come up a few times?
I haven't looked at the company in some time, but yeah, I will take a peek at it to see what's going on there.
Mark, I don't get the chance very often to ask a question to help me in my own portfolio planning, but I'm near the end of my research cycle for a particular company, and I'd like to hear if you have anything to say about Novo Nordisk.
Oh, no, yeah. It's a pretty good company. I mean, their franchise really seems to be diabetes and related illnesses, and they seem to be doing very well. They've opened a very large, not recently, but over the last few years, they've invested heavily in the U.S. They've taken over office space in the Princeton area. So, yeah, it's a company that I've done business with them over the years, and certainly not recently, but do generally have a very strong opinion of the company.
Yeah, and if you look at any of the characteristics of this company, including the stock price, there's not a whole lot of fluctuation in this company. So I think it's the type of company you can't wait for a dramatic buying opportunity. I think you have to settle for a lukewarm buying opportunity in most cases for this company.
If you scroll down to the discussion, you'll see where they talk about the company's their real focus.
Oh yeah, I hadn't read this before I made that comment, so I get one good idea for the night. Yeah, well, there's a whole lot of stability.
Puts them up against Eli Lilly.
Good stuff. Yeah, in fact, we'll probably be out with some commentary on Novo Nordisk. I know it's one that Dan Hornick had talked about. We'll be out with a Epiphany list of 12 companies or so, and I think Novo will probably make that list.
I took a
This
look at it, Jim.
this was my short list for tonight. This was my second choice for tonight, Mark. So
Okay.
I really like everything I'm reading and finding out about this particular company, even though it is an ADR and I'm gonna have to deal with currencies and all that kind of stuff. I still really do like it.
Well, it's certainly one that's been a community favorite for many years, so absolutely. All right, let's go ahead and he's going to pass. Let's go ahead and turn it over to Cy and talk about storage, apparently. EMC Corp, and a company that's very familiar to our community going back over the years. Go ahead, Cy.
All right. Thank you, Mark. And before I jump into EMC Corp itself, I see that we've had a couple of questions about BRLI, BioReference Labs, during Hugh's time. It looks like John maybe was wondering if he was ready to bottom fish in it, and Nick's just asked about BioReference with their lower top and bottom line growth going forward. Since BioReference was actually one of the stocks that I also was looking at tonight, I would just quickly mention at least what I saw in looking at it, and one reason why I ended up going with EMC. I think BioReference and what we've seen happen to it in roughly the last month is again another symptom of a stock that what we were talking about a little bit earlier in connection with 3D, which you're going to see much more frequently with companies the size of 3D, but BioReference is not a large company either, and had a tremendous run-up in price over the last few months, and came out with a disappointing projection for the last quarter of 2013 and into 2014, disappointing by BioReference standards. Again, they're still projecting somewhere in the I think the company said 10% top and bottom line for 2014. I think the analysts are going slightly higher than that, but somewhere in the range of 50 to 60% of the growth rate prior to their report. But the stock price dropped tremendously. I have it, and Manifest has it, I think, with potential return in the 13-14% range. And again, let's see, you can't really tell it on this chart, but if you notice that red price bar, which is the current price, there is still above the 52-week low, and look back at it compared to 2012, you can't see really where 2012 is, but it's going to be down around that E where Mark is pointing. So that's what I was talking about taking a perspective. If you look at the last month, BRLI has done horribly. If you look at the last year or year and a half, it's really not done that badly. Even with this last, it really ran up probably ahead of itself. And what I would also point out about BioReference, before you go dumping it, take a look at its competitors and what they are projecting. Basically what's happened, LabCorp, I think, is right now projecting low single digits growth. So 10-12% is pretty high for the industry. They're running into, I think, some reimbursement issues under the Affordable Care Act and some of those sorts of things. And it's, as I say, it appears to be somewhat industry-wide. So those are some quick comments on BioReference, since it was one of my potentials for tonight, and it is a company that I also own personally, so I follow it a bit.
Cy, I think John Kimmel has either a comment or a question for you, so I'm going to unmute him. John, go ahead. You're unmuted.
Thanks. I know you don't usually take participants as part of the program, but just real quick, and Cy kind of hit on it. Quest Diagnostics was hit also, and so it's kind of an industry thing. And one outlier might be that if the industry gets their act together, like some of the other medical device industries and things like that, they get their lobbying going, they may not end up as bad as investors think. on the actual reimbursement cuts on some of those types of things. So that may be one particular factor. And if we watch these, I know some of you don't like to trade around very much, but I didn't mind unloading some in the mid-30s in order to buy some back in the mid-20s. So just trade around a core position, and that's my main comment.
Okay. I saw those documented, John, so they're certainly welcome here.
Good comments, John. And now for my pick tonight, EMC. I decided I would try and channel Hugh McManus a little in this pick, because I already mentioned that I was looking a bit at BioReference, but again,
Cy, is this your version of an Irish accent that I'm hearing right now?
There you go. I should switch over to that. But I was looking at BioReference, but they hadn't really been beaten up enough. It still was a fair bit of a growth play. And I was looking at Cognizant Technology again, because despite the fact that it just keeps going up in stock price, the business model looks solid as well, and the projections look good going forward. But I thought that both BioReference and Cognizant may still have further hiccups ahead. So I was looking for something that hadn't had quite the price run up. And if you look at EMC here, the price chart, you can actually see it's trading today for roughly where it was almost 3 years ago in 2000. This, of course, does not give you bi-monthly, but it actually is near the beginning of 2011 is roughly where it's trading now. So it's trading. It's been flat for the last few years, although it has been growing somewhat. Mark's pulling up the price chart there. You can see on value line how it has been basically flat for the last 3 years, although the revenues and earnings have been increasing fairly well over that time, although a little slower than at some points in EMC's history. And I think there have been questions about where EMC was going to fall out in the cloud and all of these sorts of things. So there have been questions about their business and where they would fall. EMC's growth, some of you who have been, as Mark mentioned, it's been a long-time community favorite. Again, those of you who were around in the late 90s, EMC was a very popular company in better investing circles during that time frame, and was a very high growth company at the time, and has been over the last decade been growing at I believe around a 10 to 12% revenue growth rate, but it appears to be slowing down even more from that. I think Value Line and Manifest is projecting around the Value Line showing here under their methodology 9.5%. I think if you convert that over to actually the way we do, it's closer to the 9% or so range as Mark is showing on the Manifest Eagle right now. I went ahead and used about a 7% growth rate myself in my analysis, which is around where Morningstar is actually projecting a 6% growth rate. I felt fairly comfortable with 7. Looking at the history, I ended up the margin. I left exactly where Manifest has it at the 12.2. The shares, let's see, I think I used a PE of about 21, Mark. If you want to change that, was what I worked it out to. And there you'll see, let's see, and I actually annualized the payout ratio and used 30%, because they've been paying a dividend for 2 quarters. And their payout ratio, I think, is actually probably closer to about 30 if you look at it. And I came up, as you can see here, with 11.7% potential return, which I think, again, is very solid in this frothy market. And what I particularly liked about it is I don't see a whole lot of downside risk to EMC because it has been unpopular for a while. And if you look at, let's see, you don't have it on that screen. Can you show the Chronicle? Mark,
Okay,
also?
I'll jump back to it for you, sure.
Because this was I don't use this as a huge stock selection tool, but I like looking at it. And EMC, again, I think shows some very, notice both the red line, which is the par line. The absolute par line is nearing a high, as you can see, over the last 4 years. You see back in mid to late 2011, it was in that neighborhood and actually a bit higher. And if you put the relative par back in, you notice it is at an all-time high. So, so those, again, were just confirmations for me that the stock has been a bit unpopular for a while, but looks pretty solid going forward. And so that made my pick.
Certainly a
I
good
think you were ahead in your
overall
value
story.
line. I'm sorry, Mark?
It's certainly a good overall story. Storage is going to be so important.
Yes. And of course, the other thing that a lot of people may not realize about EMC as well is that they're an 80% owner of VMware, the virtualization company. And that has been a very successful acquisition for them. I think it may run around 20% or so of their profits, so it's still not a huge portion of profits, but there's a fair bit of cross-selling between the software side of VMware and their data and virtualizing servers and that sort of thing.
Anyway, I think we can leave the audience with one more thing, Si. They've got $5.5 billion in debt, but they also have $10.5 billion in their checkbook. So that's
right.
Not bad. That's the equivalent of no debt.
Yes, and I don't remember if it was Value Line or Morningstar, but it was one of those two analysts also mentioned that cash supply as giving them the ability to pump a lot of money into R&D and the like to stay ahead of their competitors.
Mm-hmm.
I think that was probably Morningstar because Morningstar gives it a narrow moat and basically said because of the fairly high switching costs of changing from data storage companies. And again, I mentioned EMC being a favorite back in the late 90s. Just think back to what technology was in the late 90s. Mm-hmm. 15 years ago, the technology world was totally different. So EMC's management has shown me that they're capable of adapting to technological uncertainty, and so I'm willing to trust the management a good bit.
Good stuff. Okay, thanks. I will add it to the stack and take it from there. Well, Ken's going to go to the other side, the nuts and bolts of the industrial world, with another community favorite.
Well, I like to try to think ahead in macro terms occasionally, and I've talked about disruptive technologies, but I also like to think ahead that where I live in Michigan here, I see the economy actually picking up, and I see things happening that I haven't seen happening in 4 or 5 years, and to me that indicates that manufacturing may be beginning to reassert itself in some areas, traditional manufacturing as well as bringing back some manufacturing is cheaper to deal with here than it is overseas anymore. I'm looking at Fastenal. Morningstar gives it a wide moat. They have over 200,000 different fasteners that they sell. They're championing a brand new distribution size from vending machines, where they set up vending machines right on the floors of factories that give parts, that give fasteners when the company needs them, and Fastenal keeps the vending machines filled, but the company doesn't pay until they actually use the fastener. there's some unintended consequences attached to those machines, and I'll talk about those in a moment. But the vending machine certainly is a brand new way of distributing these parts. Fastenal also works through a very large system, a very large network of stores throughout the country. Fastenal, in fact, is the kind of company that if you've never heard of it before, you probably never realized there's a store somewhere near where you live. Now that I put the name in front of you, you kind of internalize it. You might actually notice the store or some of the Fastenal trucks running around your city or your area. Fastenal has an extensive delivery system. They make 80% of their deliveries before 8 o'clock in the morning, and they claim to be somewhere in the neighborhood of 10 to 100 times more efficient and more effective at getting their parts to where they're needed than third-party logistics companies would be trying to do the same thing. So there's some interesting techniques that Fastenal is using to gain customers. The customers that Fastenal gets tend to be small to medium-sized industries, although they do have some very large customers, especially in some heavy industry like the automobile industry, for example. I think that if the economy is rebounding, then manufacturing will be one of the first places to see a rebound, and my investment club tends to agree with that thesis. So we're looking right now at some manufacturing, some heavy-duty industrial companies. We're also looking at home builders right now. So we think Fastenal fits this bill. I'm giving Fastenal a potential return somewhere in the 10, 11, 12% range. Mark, if you could look at their Chronicle real quickly.
Sure.
And just like Cy, I don't go to the Chronicle very often, but when I do, there's a couple of things that I look for very, I always am looking for, and I'm looking for a red line. That's the par value, and this is over a significant amount of time, 2.5, 3.5 years, and I'm looking for that red line to be at a high value. You know, I want to trace it back, and I don't want to find another value as high or higher for a period of time, and I think that's probably true about Fastenal right now. I think I probably have to go back to 2010 to find it higher. And then I like to also see the relative return. That's that red shaded graph on the Chronicle right there. And this is the first time since January 2010 that Fastenal has had any significant kind of relative return, in other words, better than the market. And in fact, it looks to me like it's higher than it's ever been since January of 2010. That tells me that I'm looking at a stock that I think has some pretty good characteristics attached to it. Fastenal pays a nice dividend. I think you'll see some of the investment clubs that I'm participating in looking very seriously at Fastenal. We've just purchased MSM Corporation. They're a big cataloger to heavy industry. And again, thousands and thousands of parts in a catalog that they then deliver when you make your order. And we really like both of these companies, MSM and also Fastenal here, F-A-S-T. So my pick for this evening with a high quality, a 90 quality rating, 90th percentile quality rating, and a par value that's 5 points better than the market. I'm going to choose to add Fastenal to the tracking portfolio.
Thanks, Ken. Yeah, that's certainly a company that's been very rewarding to a number of the people joining us here tonight, so good stuff. All right, I've got a little bit after 9:30. We do try to keep these to 75 minutes or less, so I'll try to consume 10 minutes or less and leave the floor open for some Q&A also. One of the things I thought I would do is, many of you know that we put out every Monday morning a number of things. We very often take a look at the value line low total return forecast You've seen us doing that for individual stocks, and a couple other different things, some resources from Morningstar, Value Line, S&P, that sort of thing. And what I thought I'd do is just kind of walk through some of that stuff, but not just for the current update issue, for everything, kind of a year-end look. And what I've prepared for you here is a listing of the higher Value Line low total return forecast. And again, as a reminder, for Petrobras, you can see there, let's go ahead and take a look at the Petrobras sheet. It actually ends up at the top of the chart, and the number we're actually talking about anytime we talk about the Value Line low total return forecast is this number right here. And we do think that that's a pretty good gut check, second opinion for any company. You'll notice that it's 16. Jumping back to the presentation, you'll see that number is different here. There's two reasons for that. Either the price has changed, which it has. It actually has gone down, driving that number up, or the time frame has changed. We correct that number that you see on the far right for both of those conditions, either a change in price or a change in the actual timing. And that's the number that you see here, again, corrected for any change in price. So again, taking the Value Line 1700 and looking for companies that have either good or excellent quality characteristics, as shown here by the second column from the right, and just some companies that could merit some closer looks and going shopping. Now, some of these are in a bit of turmoil. For example, one of our recent selections, Fresh Market, is having some turbulence, so that there could be a little bit of a shaking out period going on there, but pretty attractive returns. And a number of companies you've heard mentioned here in recent months. I know Ken has every once in a while talked about some of the human resources stocks. Resources Connections, an old favorite. Infosys, always kind of joined at the hip with Cognizant Technology. My selection last month, Apple, shows up here fairly highly ranked. Size, EMC, several selections of C.H. Robinson, the company that Ken just talked about, MSM. This is the ticker for MSC Industrial, very close to a company like Fastenal. So again, some ideas possibly to study, and from the very early days of the roundtable, FNFG as one of those small banks that seems to deliver pretty consistent performance, kind of waiting for those stock price to catch up with it a little bit. But Schlumberger, also a company that has been selected here at the roundtable and featured by us in our monthly stock feature a few times. So again, some shopping ideas. Just kind of look down the list, and you know, Apple does kind of jump off that to me, even though it's gone up from the high 300s to the mid 500s. I think it's still got some room to run, but it jumps off the page a little bit, as does EMC. Was my second choice tonight. You've heard everybody talk about their short lists. Well, EMC was on my short list tonight. Here's a look at another source that I thought you might find interesting. This is from Morningstar.com. It is, I believe this one is under the premium subscription, so you might have to use a library or a personal subscription to get at it. But you can actually screen by price to fair value. You'll see us mention this in many of our weekly reports. One of the reasons I put this up is there's a lot of you know, low capitalization, small companies. Some of them are on the borderline of a train wreck. But I also wanted to point out the number of commodities, the number of things that say gold up at the top of this list. Gold has been absolutely hammered. There's probably some opportunity in there if you can find an excellent company, but some of the returns, some of the fair values that some of these companies have been putting on these companies are probably suspect. My personal experience has been that NAIC Better Investing Methods, we talked about this a little bit earlier, along with Morningstar, and Value Line for that matter, seem to struggle a little bit with the non-core, more cyclical companies. S&P tends to do a little bit better job, so if I'm really looking for an acid test on some of these companies, I'm definitely going to check them against S&P as I go forward. That would be the case with a company like Ford. Ford shows up here. It's actually been dinged pretty good on the stock price. I have a feeling that a lot of that has to do with the potential departure of Alan Mulally. S&P does not have the same high regard. So again, I would always be balancing that out. But again, take a look at the number of gold and silver and coal companies that are ending up in here. And again, I would be kind of hard-pressed to look down this list and find a company to be too serious about, but notice that PBR is also on this list, Petrobras. And a little bit closer look at that list, only focusing on the companies that we use. Go ahead, Ken. What's on your mind?
Mark, Herb has a question. Would you just take a quick moment to explain which price to which fair value on that price to fair value?
Sure. They actually don't show much of anything, so let me do it over here. All the prices, and again, when you're looking at Morningstar or Standard & Poor's, they do the same exact type of analysis that we do, where when we come up with that return forecast, only they turn it upside down and backwards, and they talk about the current day price, which would deliver a certain result in the future. It's actually just the exact opposite of what we do. It's what most professional analysts do, by the way. They come up with a fair value that they can compare the current price of the stock to today. So in the case of Ultra Petroleum, they're literally taking and saying that the number is roughly going to be $42. They think the fair value of Ultra Petroleum is somewhere around $42 based on their analysis of the company, okay? And with a current price of 21, it's roughly half that, or this 54%. So in their theory is that it's, you might think of it as being 46% on sale, 46% below the fair value. And you can see these have been ranked from the lower numbers to the higher numbers. And again, anytime you get up at the top end of this chart, you probably are getting into kind of a speculative zone where those price to fair value numbers, as they get too low, they get too good to be true. The same thing we do with upside downside ratios or elevated return forecasts. Notice that some of the commodity companies did come in there. So again, you take the fair value established by Morningstar and compare it to the current price. So it literally is this $21, and you literally divide it by the 42 to get roughly 50% for a price to fair value. Obviously, if the company was at 42, it would be 42 over 42, or 100%. It would be deemed to be fairly valued. In my experience, that would mean the company has basically a market return, or 8, 9, or 10% return under those conditions. So again, it's a place to go shopping. Notice some of the companies that come up. You don't see Berkshire Hathaway here very often. It comes up on this list. Novo Nordisk, companies that Cy talked about, or Ken talked about with you. Here's one of you. This one's kind of fun. This is a company that you got me into many years ago before it had earnings. And some of you may have heard the story. The furniture in our lower level is named after this company. But one of the companies that jumps off this chart, again, just going shopping, Weight Watchers, could be interesting. Could be an interesting story. Petrobras is here again. Sanofi Aventis could be a good look. But I also like this NVO, Novo Nordisk. Here's a look at that same situation, comparing the current day price to the Standard & Poor's or S&P fair value. And you can see they have, and again, for the companies that are more non-core, like perhaps a Quest Core, I would put a little more stake in Standard & Poor's over here for some of these. Notice that Petrobras shows up here again, so I guess I should have picked them tonight. But Quest Core is an interesting study. I know a number of investment clubs have been taking a closer look at that. Toyota, beaten down by their challenges of recent years. But again, just kind of looking down the list, looking for anything that jumps off the page. We see Apple again. We see Express Scripts jumps off a little bit. But some interesting opportunities to take a closer look at. And again, I'll repeat, the higher you go up this list towards the top, the more frothy you're getting, and probably a little more caution ought to go into them. But again, S&P upped their forecast, their fair value forecast for Apple, and they actually have it at basically 25% on sale as of the most recent update. Quick look at the Manifest rank. Again, you know, this is my personal favorite for the top percentage of stocks at Manifest. It's been a little bit crazy here in recent months, but you see some companies that have shown up quite a few times. I'm going to go with SolarWinds tonight for my company. That is an information technology company, kind of a consulting or software company that has nothing to do with solar, nothing to do with wind. They're in information technology and consulting. And you can see they earned their score in the manifest rank by virtue of their high return forecast and their relatively high quality, even for a relatively small company. Interesting that Cognizant is right here, up here at the top of the list, as Cy mentioned. C.H. Robinson, pretty good. Fossil, one that we've featured in the past. Susan's selection from last month, it did take a bit of a price hit, but there's a pretty solid business behind that company, and could be worth taking a look. It could be at a reduced price compared to when Susan presented it, and I suspect it may come back and be a repeat selection in the future, because the business model and the story sure seems to be intact. Priceline has been very good to us here at the round table. It shows up here again. And again, Apple would have been probably my third selection here tonight to go ahead and repeat it. And Qualcomm's another good one to possibly kick around. So I had a hard time deciding. I'm with you. I like to buy them when they're on sale, but there are some companies that are still okay to go after. And I'll mention one more here, this Home Capital Group, ticker symbol HMCBF. That's a company that came to our attention by virtue of the Boston chapter of Better Investing, and it's quite an interesting story. Dig in. Their crime is that they have meticulously and strenuously enforced the 20% rule on the amount of down payment on all residential mortgages, and they never wavered from that. So very, very conservative, very solid banking practices, and they just trudged right through that nightmare. Did pretty well, and they've made a lot of people in the Boston area quite happy. It's a good study.
Mark, isn't this a Canadian-based bank?
It is a Canadian-based bank. Yep.
Okay.
I'm not sure where they're out of. I think it could be Toronto.
Yes, they are.
Okay, but it's a good study, and again, with all the considerations of dealing with banks outside the country. Here's a quick look at SolarWinds. We have featured it a couple times at Manifest Investing. It was a featured stock back in this time frame here, I believe, very close to these lows back in 2010. I lost my cursor. I believe we featured it as a study stock back then, went way up, and then it did come down pretty strong. Kind of the stuff that Cy was talking about, how these roller coasters can really be rather dramatic, but as long as they continually produce sales and earnings in the right direction, you can sort of overlook some of that roller coaster volatility in a company like this. Here's a look at the profitability of the company, suggesting that a 30% net margin ends up being about a 40% pre-tax margin is not science fiction. You also see that down here on the value line track record. This is not in the standard edition. It's in the expanded, so not quite as much information available. But we can also see a look at PE ratios, so you get a feel for companies definitely maturing, and the PE ratios coming down as the growth is going to mature on this company. Still relatively small. Here's a look at the worksheet, library worksheet from Manifest Investing. You can see that I have gone ahead and left it at about a 22% growth rate, could be 20. Net margin somewhere in that 30 range based on that picture we just saw. And again, even if you drop that PE ratio down towards 20-ish, you still end up with a really nice return forecast. And again, this appears to be a company that's fairly well managed and an interesting small chunk of the portfolio. So I'm going to go ahead and add them to this portfolio. I was kind of surprised we hadn't added them in the past, so this is a first-time selection for SolarWinds also. So with that, Ken, do you want to work up the poll?
Yeah, Mark, here comes the poll.
He's all ready to go.
Okay, and you know, I've added Hugh's choice. If you don't think we should be adding stock at all this month, then you can vote for Hugh's choice. That would be different than none of the above. So let's launch it, and we'll give you a few minutes to make your choice.
You're getting really fancy. Going to turn us into asset allocators yet, huh? We could do a whole session on that too, couldn't we?
He's splitting the Hugh loyalists. They don't know whether to go with do not add or none of the above. So. Of course, I guess none of the above means do not add, do not add too. So what actually does
I think none of the above means they have a better choice, Si.
Okay. I was worried. I thought he might be
okay.
chasing his tail down there.
I got you.
They could be people who like bombs. And they're wondering, how did I get into this and why did I stay so long?
I'd love to see 85 or 90% voting. Folks, just take your cursor and go up there and press one of those circles, and we'll be glad to record your vote.
I've been taking my cursor every time I see the price of all these companies I want to buy.
We have one of our largest audiences that we've had in quite a while, so this is a really good date for whoever is keeping track of dates.
Well, we do tend to like
between Christmas and New Year's, Mark.
Yeah, we will keep track of that. And Tuesday nights do seem to be pretty preferred too. So. Oh,
and I'm going to close the poll, and I'm going to share the results. And we had a barn burner here, Mark.
No, we got to call another tie.
I think we'd be happy doing that.
Okay, we'll do that. So Fastenal and Solar Winds will be added to the tracking portfolio. That takes, in my opinion, anyhow, nothing away from EMC. I think it's a good study and a good story. So we will go into a question and answers period here. I did want to make everybody aware that we will be meeting in about a month again. I believe that's a Tuesday night, January 28th. We're going to do that. Then I also wanted to make people aware that we're going to go with a special edition of the roundtable on March 1st. That is a Saturday morning. We've tried that a few times. I think if people are made aware of it a little bit in advance, we might be successful. That will be our annual awards presentation. We always have a lot of fun with that. It is the day before the Academy Awards, so we'll have red carpet and black ties and just have a whole lot of fun with our knights and guest damsels and guest knights on that Saturday morning. Could be a lot of fun. Ken, do you have any more details on the April 2014 session yet?
I really don't, Mark, except that it's going to be held at the Holiday Inn in southern Genesee County. So all of you folks that live in southeastern Michigan or mid-Michigan or even capital area or western Michigan, Flint is not a bad drive from any of those locations. Lansing to Flint is less than an hour, folks, and the Holiday Inn in southern Genesee County is a beautiful location. We have our teachers set up. We're going to stay with local folks. We're going to have Mark there. I'm going to be there. Ann Cuniaz from Better Investing Headquarters is going to be presenting, and we're going to be giving you lots of ideas. We're going to run through a short industry study, and we're going to be trying to keep your mind engaged as you decide what's best to buy at that particular time. So more information to come about April 2014. I can give you the exact date. It's the second Saturday in April. That's April 12th.
Okay, we'll go ahead and make that addition to our events roster. And then all of us will be attending the National Convention in May also. So we should have some good, clean fun there in Chicago.
Don says, I don't see a February session. Don, our February session is going to be on March 1st. And we'll have a March session near the end of March then. So, you know, they took those days out of February back in the Roman Empire and didn't leave us quite enough time here to run our February one. So why don't you imagine it's leap year and we'll put March into February right there, okay?
All right, and I think what we'll do is go ahead and sign off the official program with an acknowledgement to the otters and just say no drifting. And hope everybody's had a joyous holiday season and Happy New Year to everybody, and thanks, guys.